Good morning, everyone, from the Mount Rushmore State. It's beginning to feel a little like spring. I'm Ed Bartling, your external wholesaler. And today, I first want to say thank you, thank you, thank you. Thank you for your business, and thank you for investing your time with us today. I do believe it's going to be beneficial as you sharpen your axe of knowledge to better serve your client. A couple items. Everyone is on mute, and we will have time for Q&A at the end. So please use the area to put your questions entitled Chat. The drawing for the $50 gift card will be done at the end of the webinar, and you do have to be present to win. And don't forget, as spring marches on, we still have our ongoing March Madness giveaway. One lucky winner will choose either a locking gun safe or a flat screen smart TV. And 4 runners-up will receive a $50 gift card. The live drawing will be April 7th, and the qualification runs to April 1st. So you still have time to get those tickets in. Now, with your thinking cap on, be ready to jot down ideas that Geoff is going to share with us today. And be sure to contact your internal wholesaler for a deeper dive. MassMutual is our featured premier carrier this month, and Geoff will cover their core policy, Mutual Whole Life. Now, you may think you know everything about whole life, but maybe not. I know I look forward to hearing and learning from Geoff today. Geoff Murtha is the Managing Director of Life Insurance Wholesaling of MassMutual. Geoff is responsible for the Midwest region, and he is ready to assist us at all levels of the sales process, be it planning, selection, or implementation. Geoff has extensive experience in the product selection, case design, in advanced sales, and takes a consultative approach in helping to meet the unique needs of your customers with client-focused solutions. Now, Geoff received his bachelor's degree in economics, finance, and business management from Simpson College in Indianola, Iowa. Now, some of you may identify this little college town of Indianola, Iowa. You see, every summer, not just the college, but the whole town is filled with hot air. They host the National Hot Air Balloon Classic, and you can see literally hundreds of balloons take off in the morning and evening. Believe me, it's quite a sight. But no hot air here, folks. I would now like to turn it over to Geoff Murtha, CLU, CFP, ChFC, to tell us why whole life in an indexed world. Geoff?
Thank you, Ed. That might be one of the best and most well-researched introductions that I have ever received, especially about the Indianola, Iowa part, where I was at Simpson College and had 4 years of wrestling experience there. So the hot air and the wrestling, they don't really go together, but I did make it to see those balloons take off a few different times, and it's a really pretty sight. Ed, thanks again for having me on the call today. Thanks everyone for your time. I really appreciate the opportunity to share our story, especially as it relates today in accumulation sales in an index universal life world. So I'm going to get to it. So I do want to leave some time for questions, and there's a lot to cover on today's agenda, but I will save a lot of fun things for future calls. So what do we want to talk about today? The first thing is why whole life insurance and why now? And a lot of folks, I don't expect everyone to not know anything about whole life insurance, but there are some things that we either forget from time to time or things that are very, very brand new. So we want to talk about why that makes sense, especially in this environment. And when we talk about environment, not just the life insurance industry, but the broader scope of the world environment, the economy. So we'll talk about why I think the certainty with a product like whole life insurance makes sense in today's world. So we'll do a little bit of a product overview, just so you know what we have, and then talk about how the interest rate environment has put some stress on a lot of different products, namely indexed universal life, guaranteed universal life, and why we see ourselves as a pretty good fit in today's world, not just from a product perspective, but also from how the company is structured, being a mutual company in nature. So a lot of really cool things for us to talk about not just the products, but the company. And then we'll get into a case study or two to kind of nail the exclamation point about why this makes sense for a lot of your customers. So why whole life insurance and why now? Well, the first thing is, from my perspective, is the guarantees and the dividend and how much certainty it creates. But the buzz in the past year and a half has been the new Section 7702 impacts to how products are structured, and namely whole life insurance. It provided some flexibility to the insurance carriers and how they can price products. And what that did for the customer is allow for a lot more guaranteed cash value early on and the potential to get a lot more accumulation throughout the life of the policy. So we were really able to sharpen our pencil on what we can provide to our customers, especially as we serve the offices like financial markets and the folks on this phone. So we'll talk a little bit about that. Index Universal Life, I think that there's no secret that there's been stress. And there's no bigger believer in the story of Index Universal Life than myself. Zero is the hero. To have upside potential, there's no better story that I've come across in my years in the insurance industry. But there has been some challenges, and namely it's caps and participation rates going down, and what kind of angst that's caused and what kind of stress that's put on policy. So we'll have a case study to discuss some of that stuff. And do products like Index Universal Life, are they bad? Absolutely not. I've been part of 2 different carriers that sold IUL, and like I said earlier, I'm a huge proponent for the story. We just have to make sure that we're managing expectations appropriately, and to have an alternative like whole life insurance where I believe expectations are properly managed, and you're less likely to have to apologize to your customers 5, 10, 15, 20 years down the road. So not just Index Universal Life is feeling some kind of stress. There's been reductions, limitations with other types of products that's out there, namely guaranteed. And for the folks on the phone who've been around at least from 2010 on, there was a lot of repricing in guaranteed universal life. It was the best, the best type of product out there, especially for policy review. At least in my experience, to be able to say, hey, we're going to take all this cash value and move it over to something that's guaranteed. You don't have to pay anything ever again. Well, I think that made sense when the pricing was really, really good. Now there's a lot more pricing parity out there with other types of products. And there were some things that were exposed with those products that made it more challenging in actual application. Plus, from a carrier perspective, the low interest rate environment made it really, really hard to be profitable. So the commitment to those products has waned and gone away in a lot of aspects. I mentioned this at the top of the call, the financial environment. There's so much going on right now, and it feels like there's always something going on, but the volatility that's been expressed, especially as of late, and you look at the S&P 500, it's gone up the last 10 years, but it didn't come without volatility. Interest rates artificially low for the longest time. That's causing stress in the economy in different places. And so there's just a lot of stuff. Inflation, Ukraine, there's so many different things where there's uncertainty. Wouldn't it make sense to put a little bit more certainty in the broader portfolio, whether it's not just life insurance, but your retirement assets, to have the ability to navigate that uncertainty with something that makes sense from a certain standpoint, and we'll talk about that. And then the rapidly evolving carrier landscape. We don't spend too much time. I think you see what's going on here. I was just on a call earlier today where Ohio National was brought up, what's going on with them. So you see private equity or big investment companies purchasing big blocks of life insurance. You see Ohio National going from a mutual carrier to not. So there's just question marks around the carrier landscape. And to know that you're with MassMutual, which is a large brand name, being a mutual company, knowing that we're here to support and serve the long-term policyholders that we have, and we show that in the form of the dividend, which we'll talk about coming up. So whole life accumulation, this is really kind of a high-level overview, but we'll hit it quickly. What makes whole life insurance, especially from accumulation? Well, it's the 3 guarantees. We have guaranteed premium, guaranteed death benefit, but what jumps off the page is cash value accumulation. To have a guaranteed cash value accumulation that puts you on a higher plateau, a higher elevation of what that policy can do, because it brings so much certainty. And we'll have a case study that demonstrates that kind of certainty versus alternative products, namely IUL. The cash value growth is not directly affected by market fluctuations or conditions. This is the paramount part of our story, to be with a mutual company that serves the long-term needs of the policyholders. The strategy of a mutual carrier is to serve those policyholders, not shareholders. So we know that the earnings of the company are there to drive and to be the benefit of those participating policyholders, but to also know that when things are going on in the market, you have a non-correlated asset with a high degree of certainty to be able to reach that type of outcome that you're actually looking to reach. There's a higher probability of certainty that when we put stuff on paper, you're going to be able to meet those expectations. Now, are there things that are going to happen that could limit those products? Absolutely. The dividends can go down, interest rates can go up from an adjustable loan rate standpoint. So there are some things that take into account projections, but nothing is going to be able to have such a solid backing than what you see with whole life insurance. And the potential to receive dividends is something that we talk a whole heck of a lot about, because that's what makes the policies kind of jump off the page. Yeah, the guarantees are nice, and I think to me that's one of the focal parts, and maybe the most important part is that the ability to see that guaranteed cash value on paper, but the dividends is what really makes it pop and is the fun part of the story. Some of the other pieces of whole life insurance that you're going to hear and that we talk about a lot because it's part of the story is direct versus non-direct recognition. The fixed loan is what we would call direct recognition. We're going to charge 6% and we credit back the dividend. So right now it would feel like a wash loan. It's a lot less, it's a little bit more conservative than what we'd call our non-direct recognition, which is our adjustable rate loan. Currently on our 10-pay, we're charging 3% for the adjustable rate loan, and we have a dividend of 6%. So for those of you who can do some pretty simple math, there's some arbitrage there, which is attractive. Now that's where it's at today. That doesn't mean that's what it's going to be in the future. So for those folks who are sophisticated and they understand the concept of possibly putting a little bit of leverage into their life insurance policy to either have supplemental retirement income, or for some of the other stories that we talk about, the adjustable loan rate is a pretty attractive feature and the one that is used most of the time with MassMutual products. Competitive riders, waiver of premium is one that doesn't get talked about enough, but we have a full waiver of premium, so we'll waive all of the premium of the whole life insurance policy, and I think that's really a good story for folks who work in the doctor market, attorneys, CPAs, just those business professionals who already have a propensity to purchase disability insurance, are the folks who you can say, we can get a little bit more disability insurance in this life insurance policy. You become disabled, they'll waive the entire premium. And if you're looking at this as somewhat of a supplemental retirement program, then that retirement program is going to be self-fulfilling in the event that you become disabled. So it's a very powerful story and something I think the mutual carriers do a really good job of telling. Additional life insurance rider, that's our paid-up additions rider. So if you're looking to supercharge the cash value, that's where we do it. We drop in kind of unscheduled types of money that are not part of the base whole life insurance premium. Just know, and myself and Peter Fondano, who is my internal wholesaling partner, we know when you can use Ailer. We don't expect you to go out and talk to your customers and say, hey, this really cool rider that allows you to put more money in, because it's not what you're really trying to sell the sizzle. You have a bucket of money that you want to grow in a certain kind of fashion, that you want to take less risk, non-correlate to the market. We'll figure out the riders that we have to put on in order to make the thing sing. So that's the kind of support that you're going to get from financial markets. Life insurance supplement rider, again, we're going to know when to add these things, but just for kind of your base knowledge, this is a term blend rider. So what it's going to do is allow us to increase the death benefit at a very nominal price. You can do it, so you don't want to have cost prohibitive programs going out there. Let's say that a customer needs $2 million of insurance and you're using $50,000 of premium that's allocated. Well, that $50,000, depending on the age, is only going to buy $1 million of coverage. How do you get the other $2 million? If you want to do it the same policy, we can add on this life insurance supplement rider and do it at a pretty cost-friendly way of doing it. Premium durations, 10, 15, 20 pay. We have a paid age 65, and we also have a high early cash value product that's paid at 85. We would consider these more of the accumulation focused products. We also have a pay to age 100. We can make that kind of an accumulation product. There's some really cool things that we can do. So if you look at this spectrum, you'll see that the accumulation oriented products are the lower pay duration. Whole life 10 pay is going to get you the best bang for your buck. It has a 2% guaranteed cash value crediting rate, which just means that you're able to have a higher premium per thousand. That means that your cost of insurance is going to be managed a lot more appropriately in a 10 pay than it will with any of the other products. The whole life 15 pay, it's just as it sounds. You pay 15 guaranteed premium payments, and you're going to have a death benefit that's going to be guaranteed when the customer passes away. But it also does a really, really strong job of accumulating cash value. So the 10, 15, 20 pay are the ones that are called upon most to do that. If you have a 45-year-old and they want to have 20 pay because it gets them to age 65, or a whole life pay to 65, that's what you should use. You shouldn't always just use a 10 pay because it has the best economics, because a 10 pay can be pretty limited in that you can only pay 10 premium payments and it's done. Sometimes, you're going to have a customer who needs to pay longer than that. So you're going to have to move to one of these other products. Just know, as the spectrum moves further to the right, your guaranteed cash value crediting is actually going to be higher. So for the 10 pay, it's 2%, like I mentioned. For the 15 pay, it's 2.5%. For the 20 pay, it's 3%. And once you get all the way over to the pay to 100, it's going to be 3.75. A thing to keep in mind is that our minimum guaranteed adjustable loan rate is 1 point higher than that guaranteed cash value rate. So for the 10 pay, the minimum guaranteed adjustable loan rate is 3%, which is where it's currently at today. On the pay to 100, it would be 4.75. All right, so talk about the dividend. There's two things and probably three things you're always going to hear us talk about. One is that we're a mutual company to the benefit of our policyholders. The second thing is the guarantees, and then the third thing is our dividend. This is the performance that you would have expected from 1980 through 2022. And anyone who's been around long enough has seen that interest rates have gone down from the mid to late 80s, and it's been a precipitous drop ever since. And that's something that has caused a lot of stress, not just in the insurance industry, but other industries as well. The expectation is if interest rates have gone down for this period of time, that the performance in whole life insurance policies since 1980 should have also gone down. So let's test that theory. We have a policy that was put in force back in 1980 on a 35-year-old non-smoker. The face amount was $250,000. It was a participating policy paid at age 65. The premium was just a little over $4,000. So again, if we go back to this slide, policy put in force back in 1980, we would expect that the dividend going up through the middle part of the 80s, that you actually would have had a better dividend return through this period than what was initially illustrated at 8.27. And then as you got to the early 90s, you would have started seeing that actual dividend performance versus what was illustrated possibly start to go down, right? And I think that's exactly what I would have thought until I saw this slide. And we talk a lot about non-correlated asset. We talk a lot about having a higher risk-adjusted rate of return. The cool things about whole life insurance that is integral to that story. This might be my favorite story outside of those types of concepts. To know that looking at this chart, the the gray part of the bottom here is guaranteed cash value. That's not going to change regardless of what dividends do, up, down, stay the same. The guaranteed cash value is the guaranteed cash value. On this light blue part of the chart, that's what was initially projected from a dividend perspective at that 8.27%, which is a very strong projection. The navy blue portion of the chart is what was actually paid out in the form of a dividend. Most folks, when they see the navy blue stuff, they have questions. How the heck can you do that in a decreasing interest rate environment? You would have expected the light blue to be higher than what that navy blue is. And I think that was my initial thought coming into MassMutual about a year and a half ago. So how are we able to illustrate back in 1980, $450,000 of dividends paid over 50 years, over 40 years, but actually pay out $614,000 in a decreasing interest rate environment? Well, there's three reasons. One is mortality. And so when we return a dividend, when we pay out a dividend, we take in mortality expenses that are guaranteed at maximum, and anything that we don't actually pay out in the form of life insurance claims, that is going to go back to the policy owners in the form of the dividend. Okay, so there's a mortality reimbursement. If we do a good job of managing our underwriting, then you can expect that mortality reimbursement. The second piece of that is expense management. So we charge a certain amount for expenses when the policy is issued, and if we do a good job of managing the insurance operation, then that type of reimbursement goes back to the policyholder. So we've done a good job of managing those two elements on the expense side. The third thing is the investment component, which most folks would just look at what our general account is doing and say, oh, wow, that's gone down steadily with interest rates, which you would be right. Currently, we're in between that 4 to 5% range on a return perspective inside the general account. How are you able to actually pay out a dividend of 6%? Well, the way that we're able to do that is with our other business earnings. So other business earnings are the entities that we own outside of just the life insurance blocks of business that we participate in. So if you've heard of the purchase of Great American, the sale of Oppenheimer, when MassMutual sold Oppenheimer, the purchase of Invesco and being a shareholder there, we have a lot of these different financial services companies that MassMutual owns, and the earnings that are driven from those companies that go back to us are to the benefit of the long-term policyholders in the form of a dividend. So that also includes our non-participating policies. Those earnings also drive back to serve the dividend. So it's a pretty cool story for MassMutual to know that we have this all-in approach to serve our long-term policyholders. Last year, in 2021, we declared a dividend of $1.85 billion. About a third of that dividend return, so about $600 million, was from our other business earnings. So that is a strong differentiator for us, not just in the total insurance industry, but against the other mutual carriers. All right, now we're running short here on time, so I'm going to be quick here. I think this is something that we've seen the pain of this, and this is the conversation that's being had throughout the industry and when it comes to policy review. So for folks who have had, an IUL for the last 10, 15 years, they've seen and felt the pain of caps going down. And there's a few reasons for that. Volatility, interest rates, when they do go up, they do put pressure on options prices to what's actually paid for the caps. And so there's some things going on behind the scenes that the customers feel like, man, the S&P 500 has gone up for the past 10 years. Why is my return been steadily going down? And that's because of the caps. So because of that, I think whole life has been put into a pretty strong position to be a nice alternative in an IUL world. And again, I'm not saying this is a bad product. All life insurance products are built with the customers, with the customer in mind to benefit them. It's just, again, about managing expectations and making sure that things are appropriate for that customer's needs today. All right, so let's get into a case study. I do want to take some time for questions, but this is a really cool case study. A $200,000 annual premium, MassMutual 10-pay whole life. Again, this is going to have the best bang for its buck. That purchases a $2.8 million death benefit. We're showing this at preferred, so second best class. the thought for the customer was that they needed supplemental retirement income. They liked the idea of it being non-correlated to the market because they had exposure to the market with a number of their other assets. So this was going to be their safety bucket, a mechanism for which that when that volatility did rear its ugly head, that they'd have another bucket of money that they could tap into. So in comparison to an IUL, and this is a competitor that has a illustrated rate at 5.59%, we're showing our MassMutual 10-pay at a 6% dividend rate. The guaranteed cash value at age 65 for this 45-year-old is $1.95 million. The guaranteed cash value for that IUL is $582,000. So right there, from a guaranteed cash value perspective, we're on a pedestal. We're up higher. It's a nice vantage point for the projections to do their thing with the dividend. So the non-guaranteed cash value, we are going to lose some ground. We get up to about 3.6 million. They get to 3.7. I would still argue that for the amount of risk that's taken with the whole life insurance versus the IUL, that's a lot stronger of a value. You know, you can get 3.6 taking on a lot less risk than the 3.7, and that's going to demonstrate itself on the next slide. The income, we lose even more ground, but it's still such a strong income for what you're actually putting into it. 379,000 versus 429 for a 20-year period from 71 to 90. And so in that case, the client has some decisions to make. Do you want to take more risk with the IUL or go more towards certainty? Well, if you stress the product a little bit, if you stress the product and show some different types of returns, so a different environment, how does the whole life look versus the IUL? So the top part of the slide, the same numbers that we just discussed on the last slide, what if we do a rate reduction? And in the last 10 years, we're going to show what would have been the same percentage drop in the last 10 years and apply that to our dividend going forward 10 years. So we would show our dividend at 5.25%, and we're going to show the IUL with the same percentage drop that it would have had over the last 10 years as well. So it goes from 5.59 to 4.14. The guaranteed cash value doesn't change, right? That's guaranteed. Where you do start to see some significant changes is our non-guaranteed cash value is at 3.2. So it's a $300,000 drop, but not as substantial as going from 3.7 to 2.6. All right, so that's where the customer can start to see and feel that stress of the IUL. If, let's say, caps go down, if performance and volatility, if this, if that. There's a lot of levers and things that can be pulled that can influence how this policy would perform in that IUL world. It shows even more when you start taking out distributions. Yeah, we go from 378 to 298. That doesn't feel good. But the IUL goes from 429 to 212. Right, so that is something, again, that's the value of whole life insurance, to have a lot more certainty. Yeah, if the projections go down, does that change how our projections look? Of course. But does it change it as much as alternative products out there? No, it doesn't. And that's the value that you can bring, the certainty that you can bring to your customers as you're providing solutions to help them with not just death benefit purposes, but supplemental retirement income and using this as a tool to navigate life's uncertainties. So I'll stop there. I'm going to turn it back over to Ed to do the raffle and ask for any questions.
Thank you very much, there. A question came in is, what is the maximum loan rate for non-direct recognition, the adjustable rate loan?
So there is no maximum, and I think it's tied to the Moody's corporate bond yield. And I feel like that there's an artificial ceiling in the interest rate world, because if the interest rates do go up too high, I think that has some impending problems in how we pay our national debt going forward. So I think that interest rates probably have to be managed a certain amount at that level, and that should help probably keep interest rates in check for our adjustable loan rate.
Okay, good, very good. Another one on the ALIR rider. Is this a one-time or periodic payment? And then follow-up, and is there a type of an internal check to make sure it keeps it at a non-MEC?
So the answer is yes to everything. Can it be one time or can it be Can it be something that's systematic on an ongoing basis? Yeah. So you can have scheduled AILR, you can have unscheduled AILR. There are some rules that you have to adhere to, but you can do one or the other, or you can do both. As it pertains to MEC, is there something that can test it? In the software, yes, the software will tell you. Is there something on a go-forward basis that will tell you? The answer is no. I would run an in-force illustration. And I think with a lot of carriers, if something does MEC, you get a notice to say, hey, you put too much money in, do you want it back, or do you want to MEC this thing to make sure? So that's the kind of internal checks that you could expect.
Okay, very good. With these guarantees that we heard of, those 3 Gs there, can you maybe expand upon the use of the whole life, maybe in the college planning arena?
Yeah, so I think any type of application of the whole life insurance, whether it's college planning or supplemental retirement or, you're looking at the guarantees to create the certainty. So to know, and looking just, I know this is a little bit of a larger amount, but to know that you're going to have $2 million of guarantees after 20 years, when you put in $2 million of premium over a 10-year period, to me, I know that I'm getting my money back, and that the uses that I have prescribed for that money, there's just a lot more certainty in that. So college planning, absolutely. I think a lot of times we show college planning by putting the life insurance on a juvenile. I think that's a great story, especially for MassMutual. Ed, you did a really great video about Get to the Lifetime and how putting juvenile insurance can be utilized for not just death benefit purposes in the future to protect insurability, but also to have a bucket of money that you could gift to that child or grandchild at whatever age of maturity that you deem necessary, whether that's graduating high school or college or needing it for a down payment on a house, paying back school loans. I think that knowing that those types of those issues exist, or maybe not issues, but those milestones will exist, and to be able to plan for those and having the certainty with the cash value and the guaranteed cash value makes a lot of sense.
Very good. If we have a clients with in-force MassMutual term, can we then convert those policies with contracts through this through your network, financial markets?
Absolutely. So you can, and that's probably our biggest sales idea in 2021 and 2022 is that for existing term insurance out there that is still convertible, you can convert that through your contract with financial markets. And I didn't mention this at the top of the call, but the entity or the distribution that financial markets is a part of is called MassMutual Strategic Distributors, and it's separate from the career agency system, and it's its complete own separate entity, its own sales management team, our own underwriters, our own new business, our own wholesaling team. So there's 8 of essentially me across the country that's here to help and support. And one of the things that we've been talking a lot about is doing term conversions, and you can do that. You don't have to take agent of record. You can just, send in the conversion paperwork, and we're going to acknowledge that as the customer wanting a new agent on the case, and we'll issue the new product.
Very good. Follow up here on that term. If it had waiver premium, can I convert and waiver premium will come on over?
Yes, you can. So one of the strongest features about MassMutual and I think the other mutual carriers as well is that you can convert that term to whole life insurance with waiver, no questions asked. So whether you're on claim or not on claim. And that's a very strong distinction to make, because there's a lot of carriers, and the carriers I was at before, that if you were on waiver claim before you tried to convert, those premiums would not be waived on the conversion. With MassMutual, if you convert to our Legacy 100 whole life product, we will waive those premiums. So if you're on claim with the term insurance policy and you convert to a whole life 100, we'll waive those full whole life insurance premiums. So a very, very strong conversion privilege to be able to do that.
Yes, indeed. You know, to me, it tells me this being a mutual company, and the policyholders are ones who owns the company, that the wording of the policies are very centered around the policyholders themselves. You spoke
Absolutely.
of one of the things you mainly speak of dividends. Can you just briefly tell me, as say I'm a novice, tell me the miracle of the paid-up additions?
So the miracle of paid-up additions, and I love the way that you phrase it, and because when you look at an index universal life or a variable universal life, and you have death benefit option 2, what you're really doing is you're keeping the same net amount at risk. And I don't want to get too into the weeds here, but just know with those types of death benefit option 2, increasing death benefit types of strategies, if you start with $1 million base amount, unless you switch to death benefit option, you always have $1 million base amount, which is nice. But every single year that you get older, your cost of insurance is going up on that same $1 million. So the policy becomes more and more and more expensive, which can increase the volatility of that product in trying times. What's good and why I still focus on the certainty and the certainty and the certainty of whole life is that even with an increasing death benefit in our whole life insurance, you are not increasing the net amount at risk, which means that you're not putting that policy in any more jeopardy than you could have, like with the death benefit option 2 format. So what do I mean? Well, every single time a dividend is paid, that dividend is purchasing paid-up additions, which increases your death benefit. Paid-up additions is exactly that. They're paid up. So after they become paid up, there's no longer a net amount of risk to the insurance company, which is a really cool thing, because that doesn't mean that they can arbitrarily become more expensive over time because they're already paid up. And so that's 100% certainty of a product going forward that gets passed on to the customer.
Even though it's a paid-up addition, a little like a mini little policy, paid-up policy, is it eligible for dividends also?
It absolutely is. Yeah. So anytime, and so it has this compounding effect. So your paid-up addition is also going to receive a dividend. So it's compounding upon compounding. So like you mentioned, Ed, it's having its own little mini policy that's getting purchased every single year. It's paid up and also does participate in dividend performance.
Okay, very good. Let me just give one more look here and see if I see any other questions here. Okay. A participant here asked the question, what is the phrase, what is on claim? When you talked about the conversion.
Yeah.
So can you expand upon that? I've got this term policy, and now it's on the phrase, as you said, on claim. What could I still do with that?
So when you're on the disability claim. So okay. Very good question. So if you have a term policy or even a whole life policy, and you become disabled and you meet the definition of disablement, then you are essentially what's called on claim. You're on a waiver claim or you're on disability claim, and we're paying those premiums for the customer. So when you're on claim, and let's say that you have a term insurance policy and it's still within its conversion window, then you're able to convert that to a whole life 100, and we're going to waive also those whole life insurance premiums.
Great. Fantastic. Yeah. Let me put another scenario out here. We bought this juvenile policy, and we bought this juvenile policy with waiver premium and also a rider guaranteed insurability down the road, called maybe a GIR rider. Okay. Something happens and the juvenile is on claim, as you say, and actually one of those ages or stages appear, and they're able to exercise that GIR. Are they able to exercise it, and are those premiums also waived?
So my internal wholesaling partner, Peter Fondano, he loves this part of the story, and I bet he's smashing his computer mouse trying to get off of mute right now to answer that question. And I might have to get a little bit of follow-up on that, but I believe the answer is yes. Everything should be able to be waived going forward. I think when you go into the software and you run the illustration, that you have waiver premium not only on the base part of the whole life insurance, but also there's a portion of waiver that's paid towards the guaranteed insurability rider too, to protect for that same scenario that you just mentioned. So I believe the answer is yes, but I'll get confirmation and get it to you, Ed, and we can get that to everyone on the call today.
Very good.
Hello,
yep.
Geoff? Are you able to hear me?
Yes, Peter.
Hi, yes, Peter Fondano, everyone. Thank you so much for your time. But yes, Geoff, you are correct. God forbid if the child were to become disabled, they are still able to exercise that GIR, and we would waive those premiums.
Excellent. And folks, that's miles apart from other carriers, including other mutual carriers. When we spoke of this MassMutual term, we're only speaking only of MassMutual term to convert. Is that correct? We can't have a term with Northwestern Mutual or New York Life and convert it to MassMutual.
So that's a really good question. There are some carriers that we will allow conversion on, and I'm going to send out that marketing piece to you, Ed, and we'll get that around to everyone. We call it our platinum. So let me just pull it up right now and see if I can find anything. And Peter, if you're still on the line, if there's something that kind of jumps out to you from the platinum.
Yeah, well, the Platinum Pass, it's not really used to replace policies. It's really to use the underwriting that has been done with specific carriers in the last 5 years to get a MassMutual policy to help increase the client's protection. So we have that Platinum Pass where we can use the underwriting from specific carriers to help get a MassMutual policy.
Okay. Okay. Very good. We'll look forward to
some of the rules are. Yeah, some of the rules is, make sure that they're underwritten within a certain number of years, like 3 years or between 18 and 50. So we'll send that out and get it.
You bet, yeah. And thank you, and our internals will be sure to get it to the participants here today. Well, I don't see any other questions. I think we handled them, and thank you very much, both Peter and Geoff, for helping us there. As you can see, folks, they're right here to help us there. I'd now like to turn this over to Neil Sperling for the drawing.
Well, good morning, everyone. Thanks for joining us. Pretty good session here today. Thanks, Geoff. Thanks, Peter. And so we have all the names in the hat of those who have been on the call, and you do have to be present to win, so we'll double check to be sure that you're still on the call if your name's drawn. So this is the amazing NASA-built computer drawing software that has been shuffling here. We'll stop that, put the names in the hat, and let's see who the Amazon $50 gift card winner is. Andrew David. Andrew's still on the call, and he sure is. So congratulations, and thank you for joining us here today, Andrew. And I'll turn it back to you, Ed Bartling.
Well, thank you, Neil. Congratulations there, Andrew. Folks, I'd like you to mark your calendar for the next webinar that we're going to be having, and that'll be April 7th. April 7th will also be when we're doing the drawing, and the topic will be life settlements, the arena of life settlements. So be sure to mark your calendar, and you'll get more information from us on that. Again, I want to thank you for taking the time to invest there, and thank you very much to MassMutual on that. And folks, don't forget to contact now your internal wholesaler to do a little deeper dive from the illustrations to material. We have it here to assist you here in the world here of mutual whole life policy with MassMutual. Thank you, everyone, and everyone have indeed a good day. You take care.